Hey everybody, Chris here from projectoption.com, and in this video we're going to talk about the bull put spread strategy. And if you've been following along, this is the fifth installment of the ultimate guide to trading vertical spreads. So after we cover this strategy, we're going to talk about some of the more specific topics related to vertical spreads, such as time decay, implied volatility, and choosing expirations and strike prices. So let's get right to it. Now the bull put spread is a bullish vertical spread constructed with put options, and here is how you set up the trade. First and foremost, sell a put option and then buy another put option at a lower strike price in the same expiration cycle. Now the bull put spread strategy profits when the stock price remains above the break-even price as time passes. And we'll talk about this in a second, but really quickly, the break-even price is the short put strike price minus the premium received. So you don't necessarily need to see an increase in the stock price when you sell a put spread, as the strategy can be profitable as long as the stock price remains above the break-even price. Now, when would you sell a put spread? Well, traders sell put spreads when they believe a stock's price will not fall significantly in the near future. And that's because the trade will lose money if the stock price plummets through the put spread strikes, but at the same time, the stock price does not necessarily need to increase for the strategy to make money. So as long as the stock price is above the put spread strikes, the strategy can be maximally profitable at expiration. So let's go ahead and take a look at a real example using real historical option data to show you exactly how the strategy works. Now the stock price at the time of entering this particular put spread is $146.92. Now for this bull put spread example, we're going to sell the 145 put for $6.60, and then we're going to buy the 135 put for $3.07, and both of these put options are in the expiration cycle that is 46 days away. Now since both of these puts have strikes that are below the current stock price, this put spread is fully out of the money. So in this particular example, if the stock price stays right at 146.92 over the next 46 days, then this put spread will be maximally profitable. And in fact, the stock price can actually even decrease to $145, and the spread could still expire worthless at expiration. Now, when you sell a put spread, you are going to collect option premium for selling that spread. So in this case, we're receiving $6.66 from selling the 145 put, and we're paying out $3.07 for the 135 put. Now that means the net premium received for this spread is $3.53. Now the break-even price for this particular put spread position is the short strike price of 145 minus the premium received of $3.53, which comes out to a break-even price of $141.47. So as long as the stock price is above $141.47 through expiration, this strategy will be profitable. Now the maximum profit potential of this put spread is the premium received times $100, and that comes out to $353. Now the maximum loss for a bull put spread position is the width of your strikes, which in this case is $10 since we're selling the 145 put and buying the 135 put, minus the premium received, which in this case is $3.53, times 100, which comes out to a maximum loss potential of $647. So let's go ahead and take a look at the expiration payoff diagram for this particular bull put spread, and I'll explain to you why each of these 3 points makes sense. So let's start with a maximum profit zone for a bull put spread. Now, for a bull put spread to be maximally profitable at expiration, the stock price has to be at or above the short put strike price. And in this case, the short put strike price is $145. So if the stock price is at or above $145 at expiration, the 145 and 135 put will both expire worthless since they are out of the money, and therefore the 145-135 put spread will be worth $0. Now since the spread was initially sold for $3.53, and it expired worthless, that means the profit per spread is $3.53. And in terms of actual profits, that would be $353 per short put spread. Now let's talk about the break-even price. So the break-even price is going to be the short put strike price minus the premium received for selling the put spread. Now in this case, the short put strike price is $145, and we collected $3.53 for selling the spread. Now that means the break-even price is $141.47. Now why is that? Well, if the stock price is right at $141.47 at expiration, the 145 put will be worth $3.53, and that's because the stock price is $3.53 below that short put's strike price. Now, at the same time, the 135 put will expire worthless because it is completely out of the money. And therefore, the net value of the put spread will be $3.53 at expiration, which is the same price that we initially sold the spread for. So if we sell a spread for $3.53 and it expires worth $3.53, we don't make or lose any money on the trade, we just pay commissions. Now finally, let's talk about the maximum loss potential for a bull put spread. Now, the maximum loss potential will occur if the stock price is at or below the long put strike price at expiration. And in this case, the long put's strike price is $135. Now, if the stock price is at or below $135 at expiration, the 145-135 put spread will be worth $10. And that is because the short put strike price is $10 above the long put strike price. So the maximum value of this put spread is $10. Now, if the spread expires worth $10 and we initially sold it for $3.53, that means the loss per spread is $6.47. Now, of course, we have to convert that to actual losses, which comes out to a $647 loss per spread. So with that said, how did this trade actually perform? So as the stock price changes over time and as expiration gets closer, the put spread's price is going to be constantly changing. So let's go ahead and take a look at how this spread actually performed as the stock price was changing over time. Okay, so on the right hand side, we're looking at a chart that shows the changes of the stock price on the top part of the graph, and on the bottom part of the graph, we're looking at the changes in the put spread's price. Now again, on the top part of the graph, we can also see the strike prices and break-even price of this particular put spread position. So first and foremost, I want to focus on the period between 46 to 29 days to expiration. Now as we can see, right after the trade is entered and the put spread is sold, the stock price falls from around $147.50 down to about $141. Now if you sell a put spread and the stock price immediately goes down, you're probably going to realize losses on that put spread because the puts that you sold are going to be increasing in value, and therefore the put spread's value will also increase. Now if you sell a spread and its price increases, you will have unrealized losses on your hands. So in that first period, we can see that the put spread is initially sold for $3.53, but as the stock price decreases, the spread's value rises to a value of about $5 at the highest point. Now fortunately, the stock price did not stay at $141, and as we can see, the stock price rallied up to a price of about $160 at the highest point. And that happened in the final 29 days before expiration. Now as the stock price is increasing and the stock price was at a level above that short put strike price of $145, we can see that the value of that short put spread collapsed. And since we sold the spread, we want its value to go to $0. Now with the stock price at $157.02 at expiration, both the 145 and 135 put expire worthless, and therefore the spread's value at expiration is $0. Now since the spread was initially sold for $3.53 and expired worthless, the profit per spread is $3.53. Now in actual profits, that is $353 of profits per put spread that is sold. So to make a long story short, when you sell a put spread, you want the stock price to remain above the short put strike price through expiration, as that is how you will realize the maximum profit potential. Now if the stock price decreases during the time you have the trade and decreases to a point that is below your put strikes, then you're likely going to have losses on that position. And if the stock price is below the long put strike price at expiration, you will realize the maximum loss potential. So when you put on a bull put spread or when you sell a put spread, you want the stock price to increase or at least stay above your put strikes. Alright, well that pretty much wraps up this video. To quickly recap, the bull put spread is a bullish vertical spread constructed with put options, and that means you sell a put and buy another put at a lower strike price in the same expiration cycle with the same quantity. So if you sell 3 puts, you need to buy 3 more puts at a lower strike price in the same expiration cycle. Now, when you sell a put spread, ideally you want the stock price to rise after selling that put spread because the puts in that spread will decrease in value and therefore the spread will lose value. However, the strategy can still profit as long as the stock price remains above the break-even price as time passes. And remember, the break-even price of a bull put spread is the short put strike price minus the premium received. Alright, well at this point you've learned the 4 vertical spread strategies, and up next we're going to start getting into more specific topics, and we're going to start with talking about how time decay plays a role in the profitability of these 4 vertical spread strategies. I'll see you there.